Tokyo led the charge as investors fled the market in response to Friday's plunge in New York, with the Nikkei hitting its lowest level in more than a year. Investors dumped Japanese exporters on the back of a surge in the yen to an 18-month high against the dollar. Canon, Honda and Sony all fell more than 2% on worries the greenback slide would translate into weaker revenues from overseas sales. As the Nikkei headed south, Japanese officials stepped in to steady sentiment.
The stronger yen, though it's tough on exporters, is basically good for our country. Exporters dread instantaneous rises in the yen, but we should think in the long term, because a stronger yen means Japan is at higher value.
But there was no glossing over the dire news in Hong Kong, the Hang Seng Index finishing the day just under 4% down. HSBC fell 3.2% on exposure to the US subprime crisis. But some analysts say Hong Kong's price dive may have already hit the bottom of the market.
I think we will consolidate around 27,500, and then investors will step in to buy. I think there will be bargain hunting because the price of shares are attractive now.
While Seoul, Taipei and Sydney all followed the downward trend, major financial institutions believe Asia's fundamentals are a world apart from the West.
So the Western markets are in a terrible shape. On behalf of China, I mean, the mainland market also is pretty highly valued, I would say that. But apart from this, I think Asia looks much more healthy, and it's really a story of the US and European problem.
Tightening measures announced by Beijing also rattle the Hang Seng Index, with China's central bank withdrawing $224 billion from circulation after ordering lenders to set aside more reserve cash. And with a plan to allow mainland investors to buy Hong Kong stocks delayed until the second quarter of next year, the Hang Seng may now spend some time cooling off. Andrew Sams, Star News Asia.